Greetings, everyone. I'm Michael, and this is Credit Kuri, where we talk about credit, finance, and investments. Today, we're going to talk about what income level do you need to get a credit card. Getting a credit card opens up many possibilities, like building credit, immediate access to funds, and lucrative rewards, and much more. The only thing standing between you and these opportunities is a credit card application, which typically asks for your contact information and annual income. If you are a student, unemployed, have no or low income, or are a stay-at-home spouse, that income question may cause you a lot of anxiety. Don't let your income stop you from applying for a credit card. What counts as income and how much you need to qualify for a credit card may surprise you. Here's what you need to know about income requirements for a credit card. Impact of income on a credit card application. The annual income question was introduced with the Card Act in 2009 as a way to protect consumers after the Great Recession. The Act states, a card issuer may not open any credit card account for any consumer under the open-end consumer credit plan or increase any credit limit unless the card issuer considers the ability of the consumer to make the required payment under the terms of such an account. Under the Card Act, card issuers must make sure that the card holders can afford to pay off their balance or at least keep up with the minimal payments, which are calculated each month based on your outstanding balance. Therefore, your income helps issuers determine whether or not you will be able to make payments. However, the Card Act doesn't dictate a minimum income requirement, which means that it's up to the discretion of the card issuers to decide. Credit card income requirements. The tricky part for applicants is that credit card issuers don't typically publish minimum income requirements. Since income alone is an incomplete measure of an applicant's financial well-being, it's just one factor of more holistic measures of a cardholder's ability to make minimal payments. Debt to income ratio. Your debt to income ratio shows how much money you owe versus how much money you earn. If you are a high earner but you have too much debt, you could be rejected for a credit card. So what's considered too much debt? While credit card issuers determine their own requirements for debt to income, the Consumer Financial Protection Bureau suggests a debt to income of 43% to qualify for a mortgage. So this is usually the figure taken into consideration when credit cards are in question. Calculate your debt to income by dividing your monthly debt, car payments, child support, mortgage payments, alimony, student loans, etc. by your monthly income. Some credit cards have minimal credit limit requirements, so if your income prohibits you from qualifying for a higher credit limit, then your credit application may be rejected. If you have no credit history or a poor one and are unsure if you will be able to meet the minimum monthly payments, you could consider applying for a secured credit card, which requires you to pay a security deposit that serves as your credit limit. Lying about your income on a credit card application. You should not lie about your income on a credit card application. If you get approved for a credit card you can't afford to pay off, you'll end up in debt and it will hurt your credit score, which can prevent you from renting an apartment, getting approved for a mortgage, opening another credit card, getting loans, and much more. Furthermore, lying on a credit card application could result in up to 30 years of jail time and a fine of up to $1 million. Acceptable sources of income for a credit card application. Income from a full-time job isn't the only thing that counts as income for a credit card application. You can factor any of the following into your annual net income. Income, wages, and tips from full-time or part-time jobs or freelance work, spouse income, unemployment benefits, child support or alimony, grants and scholarships, Social Security income, retirement fund and pension distribution, savings account assets, gifts, allowances, trust funds, or inherited distributions. Credit card income requirements for students. Student credit cards are a great option for building credit with low income after timely payments. Card issuers have different requirements for showing income as a student that depends on your age. If you are between the ages of 18 and 20, you'll need to show proof of independent income or have a guardian who can guarantee payments. You can count wages from a job and what's left over from grants and scholarships after tuition is paid for as an income. If you're a student age 21 or older, you don't need a cosigner to get a credit card. Instead, you can show income from part-time or full-time employment, self-employed income, gifts, allowances, spousal income, and residual funds from scholarships and grants. Issuer-specific policies. The Card Act doesn't set income requirements, which means these requirements are up to the discretion of the card issuer. Some issuers have concrete income minimums, debt-to-income ratio limits, and minimal credit limits, which would affect your ability to get a card. The bottom line. While the Card Act states the cardholder must be able to afford the credit card payments, issuers can set their own income requirements, which they generally don't publicize. Credit card issuers factor in your income into your debt-to-income ratio to determine whether or not you will be able to make minimal monthly payments, and therefore whether or not they should approve your application. That's the basis about income when applying for a credit card. If you have any experience with multiple credit card issuers, please share your knowledge in the comments below. Thanks for watching and enjoy your day.